Hi everyone, welcome to today's session. And today's topic is Introduction to Islamic Banking. We at Islamic Banking and Finance Learning and Research Center aim to provide a platform for everyone interested in learning about Islamic banking and finance concepts. That's why today we have with us Muhammad Tayyib, who is a fellow member of AAOIFI, member of two working groups, Certified Islamic Banker, Certified Islamic Professional Accountant. We'll talk about these designations in a second with Tayyib. So thank you very much, Tayyib. Welcome.
Thank you very much for giving me this opportunity. I hope our listeners find this session useful with respect to understanding the Islamic banking and some of the differences between Islamic banking and conventional banking and some other discussions which we'll have in today's session.
So I understand a few of your certificates. There is a fellow chartered accountant and CGMA and ICAW. What is CIPA?
Yes, actually, there are different standard setting bodies working for the conventional and Islamic bodies. One of such body is called AAOIFI, Accounting and Auditing Organization for Islamic Financial Institutions. This Bahrain-based Islamic standard setting body offers a certification called Certified Islamic Professional Accountant, normally called CIPA. This is for those finance professionals who are purely working in Islamic financial industry, in Islamic banks, in Islamic equity markets, or takaful companies, so that they can better understand the application of those auditing standards, sharia standard, and accounting standard issued by the AAOIFI.
So can we say that this is kind of IFRS or accounting standards for Islamic banking?
Yes, we can say basically IFRS and AAOIFI standard are two parallel, set of standards. One serves the purely for the Islamic financial institutions, and where explicit guidance is not available for the Islamic financial institutions, the Islamic financial institutions seek guidance from the IFRS as well.
Oh, okay, perfect. So now that I understand CIPA and AAOIFI scope, so let's talk about Islamic banking. So then what's the difference between Islamic banking and traditional banking? Why do we need it?
Well, actually, this is a detailed subject, and I don't think we'll comprehend this and do some justice with this subject in a short span of time. But let me explain two or three the major differences between Islamic and conventional banking streams. The first and foremost difference is the principles. Islamic banking is based on the divine revelations and the principles which are based on the Islamic revelations. On the other hand, conventional banking is purely based on man-made principles. If we go into little detail, we have to understand the economic systems. Conventional banking is based on the capitalist economic system. Islamic banking is based on the Islamic economic system, which are two very different extremes, and even the factors of production are different. So this is the first and the foremost, where man-made laws and the divine guidance are two different aspects which are very important for the Islamic banking actually. Secondly, the money. The use of money is different in Islamic banking and conventional banking. The conventional banking considers money as a commodity, and they trade commodity and they make profit on the commodity. On the other hand, Islam considers commodity only as a medium of exchange and does not consider it as a commodity, and hence no trading of commodity is allowed. You cannot earn profit on the commodity. If you go a little bit more in detail, you will understand that the Islam also restricts the time value of money, unlike conventional banking, where time value of money never stops. Take example of the compound interest. The compounding never stops, and this is a big flaw, or a big, you can say, manipulation in the conventional banking system where time value of money never stops. So these are the two major things which I think in short span of time we must cover. And secondly, the governance, and thirdly, the governance structure. The governance structures are entirely different. On top of corporate governance, Islamic banks are also governed at one step further. That is the Sharia compliance. And for those, we have altogether a different structure that is in place for all Islamic financial institutions. So let's stick to three basic things at the moment. We will discuss further in the upcoming sessions.
Perfect. So that explains a bit. So that raises a question: if Islamic banks or Islamic banking system doesn't believe or doesn't calculate profit or income on time value base, then how do they make money? Then how can the investors be so comfortable that, hey, we are investing in bank, our investment is safe, or we are saving money with the bank, and their investment or their saving is going to stay safe? Because if you're not going to charge money, you're not going to charge interest. How are you going to make money to pay for your expenses?
Yes, this is a very actually interesting question, a very common question as well, where people believe that Islamic banking, if they don't charge interest, then how they make money and how they give return to their shareholders or their investors. Well, we need to understand one thing. At the end of the day, a business is a business. Islamic banking is also a way of business that is bound by certain boundaries which Islamic banks or Islamic financial institutions need to abide by. Islamic banks also doing the business. They also invest money, they also earn profits. For example, if Islamic banks take money from an investor and they invest in a project, they will receive a return from a project, and ultimately they will also pay profit to their investors or shareholders or account holders. The only difference is in Islamic banking, there is no concept of fixed return. The return is varied every month, every quarter, every year, depending on how much Islamic banks are earning. Whereas in conventional banking, at the moment you open the account, you know how much interest you are getting. So yes, there is a risk of variability in return in Islamic banking, but this is not correct. The Islamic banking does not generate return. They do the business as per the normal norms of the business. There are certain differences in operational matters and certain differences in way of doing business that are distinct from the conventional banks. Islamic banks do earn money. They share the profit with their customers, but the profit distribution mechanism, which is altogether a different subject and a complicated subject, yes, but the only risk, as I mentioned, the credit risk will remain the same. Operational risks are more in Islamic banking as compared to conventional banking. The market risks are almost remain the same. The risk that is unique to Islamic banking is basically the risk of variability in returns.
Okay. If an Islamic bank has some spare funds and they don't have any projects to invest, can an Islamic bank invest that money in a conventional bank and earn interest from there?
No, the answer of this question is a straight no. Islamic
Perfect.
banks cannot do any business with the conventional banks because interest is the element that is strictly prohibited in Islam. On the other hand, Islamic banks can borrow money from the conventional banks because they are doing the halal business and they are doing business in a Sharia compliant manner. So in the nutshell, if I say Islamic banks can borrow money from the conventional bank to invest in their products which are Sharia compliant, but Islamic banks cannot invest their money into the conventional banks that are earning interest.
Oh, okay. So is there a central body or some kind of governance system that ensures that all products an Islamic bank is offering are Sharia compliant? Like they're in line with
Yes,
Sharia's requirements and
there
everything.
are this aspect has been given the due care in Islamic banking structures. Every financial institution that offers Islamic banking services is governed by a Sharia board or a Sharia advisor. So
Okay.
basically, if I summarize this structure in a very simple way, on the top of such a structure is a Sharia supervisory board or a Sharia advisor, and that is supported by a Sharia audit and Sharia compliance and Sharia risk functions. That is on top of the normal corporate governance structures we found in conventional banks or conventional financial institutions. So that is why AOFI has issued separate governance standards, how Islamic banks governance will be run on top of their normal routine corporate governance structure. So there are set criteria that who can be a Sharia advisor or who can be a member of Sharia supervisory board, who is qualified to become a Sharia auditor or Sharia compliance officer or a Sharia risk officer. In a separate session, we will cover all this in detail, inshallah.
Okay, perfect. Thank you very much, Tayyib. So this is a bit high level now. Let's talk about a couple of products. Like if somebody wants to buy a house, they go to a conventional bank and they get a mortgage. And then they keep on paying the mortgage. I want to understand what kind of products. Is there a short list, or everything that conventional bank offer, Islamic bank has similar services or similar products that they offer? So let's start with the example of mortgage. Do we have anything similar to a mortgage?
Yes, let me answer the second half of the question first.
Okay.
Not everything a conventional bank can do, Islamic banks can do. For example, a personal loan on the prima facie is not allowed in Islamic banks because they are not supported by the assets. Any transaction that is supported by the assets can be financed through through an Islamic bank with certain conditions. Let's take example of mortgage. In case of a conventional mortgage, it is merely a transaction that involves between the borrower and the lender exchange money and nothing else. In this case, the house is basically owned by the borrower, mortgaged to the bank in the conventional banking. In comparison, in Islamic banking, we have many contracts that can be used for the home financing or the house mortgage. For example, there is a contract of ijara, which is counterpart of operating lease that can be used for home finance. There is a concept of diminishing musharaka contract, which is a joint ownership. This is used for home finance. There is a contract of murabha, which is buy and sell. That is also used for home finance. So there are multiple avenues available in Islamic banking to cater the home financing needs of all kinds of customers.
Well, thank you very much, Tayyib. So just for this was a very, very informative session. Thank you very much for watching the video today. You can follow us on YouTube, and you can also visit our website for a list of courses and training available. Thank you. Bye.